All right. Hi, fan club. How's it going? Hey, everybody. I'm Izzy. I am head of staking at Lido, contributing to the Lido DAO. And today we'll be talking about Lido's upcoming upgrade, Lido V3, and how in totality, so the Lido that we have now, what we call Lido Core, plus the new product that will be coming with Lido V3 is the most decentralized and most liquid way for institutions to stake on Ethereum. So yeah, that's me. All right, what is Lido? Lido is a liquid staking protocol. So really quickly, for those of you that don't know, when you stake on Ethereum, you essentially need to take the capital that you would allocate to validators, and it gets locked on the beacon chain. So there's a very high opportunity cost for doing this. What Lido does, and Lido is a set of software that essentially lives on-chain. It's middleware, so it's not like me taking money and moving it between places. Is that it allows people that stake with Lido to have the optionality of DeFi, of using this capital at the same time that it's providing security and safety to the network. So it does this using robust infrastructure and in like a semi-permissionless way, which we'll go into a little bit more detail. But it is essentially the most accessible way for anybody to stake on Ethereum right now, at any deposit size and at any withdrawal size. It is middleware in that it connects users, so users with ETH, to hundreds of different node operators across the globe at this very moment. And it is governed by a DAO. So there's like very few real projects on Ethereum that are true DAOs. And by that, I mean there's no legal entity around or on top of the DAO. It is essentially governed by the different LDO token holders. I think there's a few of them here, like in the front of the audience. That's why they're so excited. And so like the code and the policies that drive this mechanism that powers like over $20 billion and secures the Ethereum network is purely driven by code and by the people who are voting on these things. So this presentation is, if you want institutional staking on Ethereum to be maximally decentralized, and I think that we do, the simplest path to this is using Lido. So why do we care about something like this? Why do we want stake to be maximally decentralized? If we think a little bit about like this reinvigoration of the ethos around what is Ethereum trying to do in the blockchain space. Tamash's opening remarks around CryptoPunk values, decentralization, privacy, accessibility for the people who usually don't have access to like highfalutin financial systems. We essentially, in order for these systems to be resilient to global balkanization, if we can even say something like this at this point, of the internet, to wars, to economics that are essentially creating some like forces for some countries to start turning inwards as opposed to outwards. What you want is a truly neutral, credibly neutrally resistant place for all of this economic activity to settle. And in order for it to be robust and credibly neutral, it has to be decentralized. And so that means when large stake starts to be allocated to this layer, so essentially we're talking about institutional staking, it needs to be done in a way that protects these core values. And that's what Lido allows huge amounts of stake to do. So with V3, which is slated to come out sometime around September, October, there will be two ways to do this, essentially like two main products to the Lido protocol. There is right now Lido Core. It's what we're calling the Lido that has been built up until now. So this is the encapsulation of the protocol thus far through its two largest upgrades since it was first launched in December of 2020. ETH in Lido Core is distributed according to programmatic rules that are essentially built into the smart contracts of Lido. And it decides how ETH is allocated to these different node operators across the globe. And then we will have stVaults, and stVaults are like essentially the big banner addition in Lido V3, which are new mechanisms that allow for tailor-made, non-custodial, and even custodial, technically, permissionless staking setups. So users, whether they be like plain users, just normal retail users, or whether they be issuers, or whether they be custodians, or banks that are looking to create like more complicated products, get to choose how their ETH is run, who runs their ETH, and who is essentially allowed to access those validators to potentially mint stETH against it. So let's look a little bit at what Lido Core does right now in order to like maintain the safety and decentralization of Ethereum. If we look at validator client diversity across Ethereum and across Lido, we actually see that the balance of client makeup in Lido is better than it is on the network in average. If you look at specific node operators, with the exception of a couple, they usually use maybe like one or two configurations in order to drive their stake. And the reason for this is that it's pretty like expensive to maintain multiple different configurations of running validator infrastructure. And the way that Lido works is that it allows you to distribute the stake across a multitude of different node operators who make different choices about how they run the stake, where they run their stake, and what kinds of things they prioritize. And let's look at the number of node operators that are running the stake. So there's 37 curated node operators that are running the vast majority of Lido stake, and this is in part due to how the protocol built up over the last 4 years. But there's also 300 simple DVT node operators. So these are node operators running in distributed validator clusters of 7 participants each. The clusters may range from hobbyists that are running their nodes like in their desk or in their mom's basement, and even running nodes together with highly performant professional node operators. 280 approximately, according to our analysis, unique community staking module node operators. So the community staking module is currently the only way for permissionless node operators to join the Lido protocol. And it's slated to undergo its upgrade in September of this year, after which it will go from like approximately 2% of Lido stake to hopefully around 5%, and hopefully something like 10 to 15% within 12 months following that. In total, this brings us to over 600 node operators that are currently using the protocol right now. And if we compare that to what the state of stake, let's say in Lido was 1.5 years ago, we only had these 37 curated node operators working. So the last 2 years have all been about building infrastructure that will essentially allow the decentralized robustness of the Lido protocol to explode in order to meet the incoming anticipated capacity, both from retail becoming more well-versed in crypto, but of course, institutional capital being interested in playing in this market. So there's 3 modules with over 600 node operators currently essentially operating the stake. 95% of the stake is across these 36 professional node operators, but all new stake goes to the smaller modules. It goes to the simple DVT module, and it goes to the community staking module. And so essentially this means that through an organic process, as withdrawals come into the protocol, they're taken away from the largest module, the curated module, and the very large professional node operators. And as new deposits come in, they get shifted into the simple DVT and the CSM modules, where you have everything from home stakers to professional node operators. So just as an example, if we were going to have like a 50,000 ETH deposit, and we imagine that these modules had the following share limits. So a share limit is the maximum potential stake that a specific module can operate of Lido Core. We might see validator deposits look like this. So CSM has a current share of 9.7% and thus has like a 0.3% remaining capacity. Simple DVT has the same. And then the curated module is kind of like the bulwark module where all remaining stake can be allocated to. So if we had 50,000 ETH get deposited into the protocol, we would see 500 validators first get deposited to CSM, and then 500 validators deposited to simple DVT, and the remainder deposited to the curated module. If these modules had more capacity, so the smaller modules, then all of the stake would be deposited to these modules. And you see something like this in this example, where again, we will look at 50,000 ETH being deposited, but SSVLM, which is a new module that is being worked on by SSV and is purely DVT and permissionless based, would accept the lion's share of these deposits, and then you would have CSM accept more deposits and simple DVT accept more deposits. And this really builds into reinforcing the constant robustness of the protocol by seeding ETH and validators to new node operators that are running like in more remote locations, in more robust setups, and with like different kinds of censorship resistance guarantees for the network. So the second part of this is that if we want institutional staking on Ethereum with maximal ability to service redemptions, we want the best way for on and off chain liquidity. And again, the simplest path for this is Lido. So what do we mean by this? If you are an institution and you want to stake, like, I don't know, let's say $1 million worth of ETH, you want to do it with as high a stake rate as possible. In traditional financial instruments, this probably means that you would be staking somewhere between 50 to 60% of the capital, and then retaining around 40% of it in order to service redemptions. With Lido, you don't need to do this. You can stake 100% or a little bit less if you want of the capital, and you can use the stETH liquidity minting option to essentially service these redemptions without needing to make a large portion of this capital unproductive at the same time. So let's look at liquidity for stETH, and right now this is purely boosted by Lido Core. Over $5 billion are used in collateral as DeFi and on some centralized exchanges. There's over $100 million in trading volume on 30-day moving averages. There's 26 node operators with type 1 and type 2 SOX certification. So a lot of times institutions say, well, we need our node operators to be compliant. Lido is the largest concentration of compliant node operators in any staking solution on Ethereum. We want liquidity, and so you can service liquidity of around $75 million currently with the depth of stETH on the markets. And we already know that approximately 10% of minted stETH right now, so stETH that's circulating, is held by publicly identifiable institutional stakers. And there's curated node operators that are also working on other types of certifications, such as ISO 27001. And Lido also worked with third parties in the past to create like open source risk management systems for these operators, and we're looking to standardize this sometimes this year. So what do vaults essentially allow? With vaults, we take a model where Lido was a one-size-fits-most and turn it into a many sizes fit all. With vaults, basically everybody can win. It aligns the interests of stakers, node operators and asset managers, or DeFi curators and custodians, if you want to think about it this way. It essentially allows you to wrap your validators or your stake, and that stake to be run in any way that the vault operator might want. And then it allows for the optionality of stETH. So you don't actually technically even need to mint stETH if you're going to be running an stVault, but it does give users that optionality. And so this optionality gets translated into a variety of different end user products. This might look like taking stETH and using it in restaking. It might look like leverage staking, where you can loop against DeFi markets. And it might look at something like creation of structured products, which are especially appealing to institutions, where you can create like delta neutral strategies, where some ETH is staked, some stable coins at the same time are put into a strategy together, and then those products are sold to end consumers. These are like new mechanisms that allow for tailor-made non-custodial permissionless staking setups. So as I mentioned earlier, whoever is creating the vault, or whoever is essentially sponsoring the capital, can choose which node operators operate these vaults, how they operate these vaults, if they want to, for example, opt into additional infrastructure, like running pre-confirmation sidecars that allow them to leverage extra functionality to sell to L2s, whether they want to support based sequencing on layer 2s, or those that support it at least, and a lot of different things like that. Some players are, like, for example, like BTCS, which is a listed company in the US, is even interested in building their own blocks. And the more validators that you run, the easier it is for you to execute against something like this. Finally, the ability to stake into a vault and mint stETH against it, and then control whether that's done in a permissionless or a permission manner, essentially allows you to create products that you otherwise wouldn't be able to do. So if we have like a financial institution that says, I want to stake everything, but I don't want to pay a minting rate to have 50% of stETH minted at the same time, they can choose to only mint a small amount when they only need it for redemptions, work with authorized participants or market makers, like using a credit line, and then they can optimize the yield on the product that they would sell to retail customers. So essentially, Lido is expanding from a single staking product offering into a customizable and modular infrastructure primitive. This diagram is a little bit complicated, but it kind of explains like the basic way that vaults work, and I'll talk you guys through it. So if you stake like 100 stETH, you can put it into a vault, and you choose how that vault is run. You can choose the node operator, you can choose the validator infrastructure, you can choose whether they use this distributed validator technology or not, and then you choose how much stETH to mint against it. So it allows you to create strategies and financial products basically that you wouldn't have normally, where any ETH that goes into Lido Core just comes out one-to-one in the form of stETH. So why are vaults better for the ecosystem? For example, let's consider a potential hypothetical future of an unnamed centralized exchange, which happens to leak private information. And currently we have little to no information about how they actually run their validator infrastructure. So this centralized exchange might be running like 15% of the network, but we don't know which node operators they use. We don't know why they choose the node operators they choose. We don't know what the reward structure is for those node operators. Like, are they actually making money? And if they're not making money, how does that make business sense? And we have irregular reporting of staked assets, questions over custody, and other business lines. So with a protocol like Lido, everything is fully transparent to the broader ecosystem. And that's the great thing about building on a fully transparent blockchain. We have insight into node operator selection, verifiable data into on-chain rewards. So how many rewards are generated on a daily basis, how those rewards break down between execution layer and consensus layer rewards, or potentially even sidecars, and how many of those rewards go to node operators, and whether that's sufficient to basically make those businesses sustainable. And on the vault's perspective, we have like a risk analysis and reserve ratios which control how much stETH can be minted against vaults, and these are all publicly set by the DAO. So they would be set via votes, and there will be full transparency for the potential users of these products, and nothing hidden behind like legal contracts that are opaque to the broader ecosystem. So let's look at a potential stake of institutional staking like in 2028 if there was like no Lido involved. There might be a large centralized exchange with around 40% of stake. There might be 20% of stake across a variety of smaller venues. And then you will probably have a couple of node operators, node operator 1, 2, 3, and 4 there, that essentially stake is subcontracted to in aggregate with the stake that they will have like via direct contracts. So it's like not a very robust and decentralized kind of like state of the system at the end of the day. If you take the same amount of stake and you map it to how it might look like, how it might be distributed on Lido, it might look like something like this. So you would have approximately 60 to 70% of that stake supported by Lido Core, which would be supported by the modules that we talked about, the curated module that has a large amount of professional node operators. Right now it's 36, but it might be like 50 or 60 in the future. You have the community staking module, which is set to increase from the current 2% to 10% by the end of the year, and potentially even higher later, with hundreds and potentially even thousands of permissionless node operators, including home stakers. You have DVT modules, such as SSVLM and Simple DVT, where node operators are running the stake in concert, essentially providing like the most robust validator staking infrastructure possible. And then you will have an assortment of different vaults catering to different needs, whether those are regulatory needs, where somebody might want node operators from only a specific region, or whether those might be needs that are catered towards getting the most bang for your buck in terms of like yield out of the validator setups. So with stVaults, users can choose whether to deploy their stake in a DeFi via stETH or not. So it allows you to run the gamut of risk appetite. You can set up delegated one-to-one stake with operators of your choice. And you can opt into riskier DeFi segregated from Lido Core. Essentially, this means that whatever is happening with regards to like the APR of Lido Core and their underlying validator set, it won't directly affect vaults, and vaults won't directly affect Lido Core. And this allows people to further use their own risk management systems, or essentially you can opt into somebody else doing the risk management, like a DeFi curator. So who can use stVaults? Somebody like an APR maximalist, if you want to amass like a large amount of ETH, like a couple 100,000, put it into a DeFi vault, and then you can loop it. So ETH gets deposited into stVaults, and then you can mint stETH against it. You can then take this stETH and go to Aave and borrow ETH against it, and take it back into a vault, and deposit it into the vault again, and then stake it and get stETH out of it, et cetera, et cetera, et cetera. So this allows one to do looping that one would normally do on their own, or using like a smart contract that facilitates the automated looping strategy with stETH. But it allows them to do this by, at the same time, picking the node operator. So a node operator can offer this as a service to their customers, whereas previously they wouldn't, because the stake would not be directed directly to them. And it also allows other protocols to benefit from this. So if you're building a sidecar right now, and you want to essentially guarantee that a certain percent of stake on Ethereum is using the sidecar in order to offer additional functionality and services to users, you can work together with a node operator that would be running these vaults and incentivize stake that is working in these vaults. And through the looping mechanism, you would essentially make a multiplier on the potential rewards that would accrue from these incentives. Then you can look at strategies using DeFi protocols like Melo, Instadap, Fluid, et cetera, where essentially you take the vault that is producing a steady amount of rewards over a steady amount of time, wrap it in some sort of DeFi mechanism, whether that's a lending protocol or a stablecoin protocol or anything else like that, and then hook it into other sub-DeFi strategies if you want to, like Pendle or anything that might be like delta neutral. And lastly, like we mentioned, there's a very large institutional use case as well, where institutions might be looking for maximum effective rate on the capital, but at the same time, maximum and instant liquidity. So one of the big problems with liquidity is that if you need like very large amounts of redemptions, you need to rent it. And renting usually comes with like very high credit costs. In the case of stETH, the cost is much reduced because stETH is essentially stake that is already gaining rewards. And so the market maker that you might be making a deal with would not have to charge as much of an interest rate. So a V3 is live on testnet right now. Actually, the second version of it just came out a couple of days ago. It's live on Ethereum Hoodie. As a node operator, you can already start building vaults as a curator or asset manager, you can start developing strategies and working with node operators to figure out how you can tie your strategies into them. And as an institution, you can start thinking about how you might want to tailor your setup, which node operators you might want to work with, what kind of setup you might want from a validation perspective, whether you want to use distributed validator technology or not, and I think I've lost my mic. Okay, and like all the different parameters that you want to set up. And that's it. Thank you.